Okay, let's talk about technical analysis, or TA. You've seen the charts, the lines, the patterns. It promises to bring some kind of order to the absolute chaos of financial markets. But what if the whole thing is built on a massive, fundamental misunderstanding of what a price even is? What if those charts you're staring at are telling you a story that isn't true? Let's dig in.
It's easy to see why people love it. I mean, in a world that's so unpredictable, TA gives you something to do. You can draw your trend lines, you can calculate your indicators. It gives you this feeling of agency, a sense of control. It feels like you're taming the beast, right?
But this is the big question we have to ask ourselves. Do all these patterns and signals, do they actually predict anything? Or are we just, seeing faces in the clouds? So let's get into the first major flaw. And this one goes right to the very core of what a market transaction even is. We have this idea that a price is a moment of agreement, but it turns out the reality is the complete opposite. Think about it. Every single trade, every little tick you see on a chart, that's not a consensus. That is a moment of profound, fundamental disagreement. For a trade to even happen, you need one person who is absolutely convinced the price is going up and another person on the other side of that trade who is just as convinced it's going down. And that's the conflict right there, isn't it? The buyer looks at the chart and says, this is cheap, it's going higher. The seller looks at the exact same information and says, nope, this is expensive, it's time to get out. So for every buy signal you think you see, you have to remember somebody else is seeing a sell signal, and one of you is about to be proven wrong. This really captures the problem perfectly. Technical analysis often ends up just focusing on one side of that tug of war, maybe the buyers, but it completely ignores the fact that there is an equal and opposite force of sellers pulling just as hard in the other direction. You're only seeing half the picture. So this tug-of-war idea, it actually builds to an even deeper, more fundamental problem with TA's whole methodology. It has to do with the information it uses, or maybe more importantly, all the critical information it just decides to ignore. Here's the paradox in a nutshell. At its core, technical analysis is trying to use past prices to predict future prices. It's using a variable to predict itself. It's a completely closed loop. But think about it. Can a system really predict its own future just by looking at its own past? And the answer is, well, no, because real-world markets are not closed systems. They're open systems. They're constantly being slammed by new information from the outside world, what we call exogenous inputs. We're talking about things like a central bank suddenly changing interest rates, a war breaking out, or just a massive, unexplainable wave of human panic or euphoria. That's what really moves prices. So, if you want to know how markets actually work, it's pretty straightforward. Some new piece of information from the outside world hits the market system. Then, millions of people process that information, and out the other side comes the price. Input, system, output. But what does TA do? It completely ignores step one. It just takes the output, the price, and tries to plug it back into itself to guess the next output. It's literally trying to fly a plane while completely ignoring the engine and the weather outside. I love this analogy. It's like trying to become a chess grandmaster by just studying a list of old moves. You're ignoring the actual rules of the game. You're ignoring your opponent's strategy. You're ignoring the fact that there's another thinking person on the other side of the board trying to beat you. You're missing the whole point. Okay, so if TA isn't really based on logic or a cause and effect relationship with the real world, then what is it? Well, this is where it starts to look less like a science and a whole lot more like a belief system. Now, you might be thinking, but wait, sometimes TA does work. And you're right, it can. But it's often because of this concept called reflexivity. Basically, if enough traders all believe that a certain price level is important, and they all place their trades around that level, well, their own actions cause the price to react. The prophecy fulfills itself, not because it was true, but because enough people believed in it. This is the perfect way to think about it. It's like a village that believes a specific rock keeps tigers away. And it works. No one gets attacked by a tiger. But is the rock magic? No. The belief in the rock is what makes everyone act cautiously. A T pattern works the same way. It's a social agreement. The second people stop believing in it, the tigers come back. And when you really look at it, the parallels to a church are pretty wild. You've got these revered prophets like Eliot and Gann. You have sacred texts full of these secret patterns. You have different sects like the Elliott Wave people arguing with the candlestick chartists. And most importantly, you have a dogma that can never be proven wrong. Because if a pattern doesn't work out, it's never the theory's fault. Oh no. It's your interpretation that was flawed.
So, if we've just established that TA isn't some magical predictive science, does that mean charts are totally useless? Should we just throw them all out? Absolutely not. The key isn't to get rid of the tool, it's to completely change how we think about what the tool is for.
And this is the most important takeaway. Charts are an incredible tool for description. They tell you the story of what has already happened, the history of that tug of war between buyers and sellers. The huge mistake is when we take that description of the past and think it's a divination of the future. So let's reframe this whole thing. Technical analysis is not a crystal ball. It's not a predictive science or some path to easy money. But you know what it can be? It can be an amazing risk management tool. It can be a way to gauge the mood of the market. And it can be a great place to generate new ideas that you can then go test with other methods. So a much smarter way to use TA is to focus on what it's good at. You can use charts to set clear, objective lines in the sand for your entries and exits. That's good risk management. You can use them to get a feel for the crowd's psychology. Are people fearful? Greedy? And maybe best of all, you can use a chart pattern to form a hypothesis and then go do your homework with fundamental analysis to see if it actually holds up. In the end, it all comes down to not confusing the tool with the truth. The danger is when we start mistaking the map for the actual territory, and when we put all our faith in that magic rock, just because everybody else tells us it keeps the tigers away.